Okay, so this is the fun part. I love this. Okay, we're going to talk about the actual, the generally accepted accounting principles. Okay, so we need to know all of them. And I worked so hard on this slide for you guys to make it so presentable and so easy to understand, because I know a lot of people don't like financing stuff, especially accounting. So I tried to make it as fun as possible for you. Okay, so please appreciate this. Okay. So the cost principle, like this is going to be kind of like a cheat for you, right? And we're going to go one by one. So let's start with the cost principle. So the cost principle, it's applicable to, think of it as the word cost. What was the cost to me, right? So when I paid for something, what's the cost, right? What you paid for. That's what we're going to put into the books. So it says record the amount of what you paid for an asset at the time of a purchase and not the current market value. So we can talk about the real estate right now. We're talking about a car. Okay, that's an asset. So if you buy a car for your real estate business, what amount should you record in your into your books? Okay, ICBC's insurable value of $60,000, listed price was $68,000, what you negotiated and you paid for, or the car's market value that it's been appraised for. You're smart enough, and it says the cost principle talks about the cost. How much did it cost me to do this? So you know that has to be what you negotiate and what you paid for, and that's the number you're going to put into your books. Is that easy? Okay, good. So the next principle that we have is called the revenue, a revenue recognition principle. Keyword that I highlighted for you is revenue. So we talk about revenues here. Okay, revenues. That's it. That's all we're talking about. It's when you earn, and that is a tricky principle. Because a lot of times, especially when we deal with pre-sales, let's see if I'm talking about the real estate agents, what happens, you can make the money way before you receive the money, okay? Because you can sell something, but the completion can happen in a year or two, and that's where you're going to get paid. Interesting, right? So when are you going to put those money, what you earn, into your books? So revenue should be recognized, recorded into your books when you earn them and not when you actually receive them. So let's say in 2025 you sold a place, a pre-sale to somebody, and the completion will be in 2 years. It's interesting. So when are you going to add it to your income as which year? Is when you earn it. So 2025 is when you're going to put it as an income for yourself, even though you haven't received the money for the next maybe 2 years, but you have to pay the taxes on this income for this year. This is how it works. So if you help sell a property and get $10,000 commission, okay, December 1st, 2025, subject clauses are removed and deposit is paid. Okay, this is what we go celebrate. So in real estate, we always celebrate when they give us deposit, remove the subject. We know this is where we earned our money. Isn't that crazy? January 15, 2026, completion date, right? And that's when you get paid. Which year you're going to put it as an income for yourself? Hopefully you already know that. It has to be the 2025, right? So you have to put it is when you earn it and not when you actually receive those money. Okay, but when I say revenue, right, think of it, okay, money coming to me, and how do I put them in my books? The next one is called matching. And some people say, but why are they talking about matching? We're trying to match up things. So if we put the revenues in our books is when we earn them and not when we receive them, so we're going to match up all the other things to it. And in this case, we're going to talk about expenses. So you're going to put the expenses into your book in the same way as when you earn your income, right? We're trying to match it up. Expenses should be recorded in the same period as the revenues that they help generate. So recognize when they incurred and not when you paid them. So think of the expenses in the same way as the revenues. We're trying to match it up. So in our system, everything matches, right? So Joe bought $500 worth of advertisement in January. This $500 is not due until March. So in which months is he going to put it as an expense to himself? Okay, it's not when you put the money in the pocket. Okay, it's not when you pay for something. It's when you earn the money or when it's incurred. And when it did incurred, he got it in January. So you're going to put it into the books which months? In January and not in March. Okay, we're trying to match it up, and that's what they call the matching principles. Then we have the objectivity principle. Okay, basically I said, prove it. Prove me that you spend those money. Prove me that was something. Now, in accounting, this is all they want. They always want to see the proof of things. And if you don't collect those receipts, or if you just pay cash for something, you can't really prove things. And you cannot really add it to your books. Right? So if you want things to be in your books and you want to, I don't know, maybe make your income less, make sure that you collect all of the receipts to prove that that was my expenses, that was my expenses. So use verifiable evidence, right? Receive contracts, statements, whatever you have to prove it. For all the entries, not options, right? No, sorry, not the opinions. It's not what you thought, or you can't just come up with the numbers out of the blue, basically, right? So it has to make sure that the CRA, when they come after you, they say, okay, yeah, that's a proof, that's a valid proof in here, okay? So for the exam, they say it's closely aligned with the cost principle, right? So what's the cost is what you paid for, right? Because the most reliable way to ensure the objectivity is recorded in the transaction is the actual amount that is paid, right? And the date of the transaction. So if you paid for something, you got the receipt for that, that is a proof, right? If you paid cash, that's the problem. It's hard to prove it unless they give you the receipt. It's okay. Okay, consistency principle. The word is consistency. They say, look, if you adopted this GAAP, right, the general accounting, accepted accounting principles, then you'd better stick to them, right? Keep them going. Keep it the same every single year. So if you put your revenues when you earn them, not when you receive them, you put your expenses when it's incurred, not when you paid for them, keep it going for all the other years. So use the same accounting method each period for the comparability. So it's all the same, right? So the changes to the accounting principles should be only made where the changes result is providing more relevant and useful information to the user of the financial statements, which makes sense, right? So you have to make sure that you are consistent every single year. So the next principle is called materiality principle. And my students always say, what is this about? So materiality, think of it as the financial reports only have to include the information that will be significant, which is material, right? To the user, small items can be simplified. So basically, this is a good example, right? If you buy a $5 calculator, you don't have to put it as an asset to your company because it's too insignificant. It's too small of the item. You can just write it off as an expense to yourself, to the company. So you can simplify how you use, or how you can apply principles to the small items. Okay, hopefully that makes sense to you, right? So I'm not putting it as an asset to my company, a $5 calculator, but I'll put it as an expense to myself, as an office expense, just to simplify things in here. So small stuff doesn't really matter, right? That's kind of my phrase for this one. You're going to be focused on the material, significant things in your books. Okay, it is an exception to the matching principle, because what's matching is about testing you, right? What are we trying to match up? The expenses to the revenues, right? So we try to keep them all in the same matter. So it is an exception here because this is where you have an option. Are you planning to record it as an asset, or you're gonna put it as an expense and just kind of, work with that way. So you have an option here how to work with things. So this is it. Hopefully it wasn't too complicated. Hope you like those principles. On exam, they always going to test you and give you at least 2 questions on different principles, right? Mark my word on that. You'll see it on the exam.